Welcome to PhillipCapital's Weekly Market Watch. The US Department of Labor reported last Wednesday that the consumer prices made their biggest jump in June in almost a year. Does this suggest inflationary pressure are intensifying? Should investors be concerned with inflation or deflation? Let us find out from Ms. Hilary Ho, investment analyst from PhillipCapital Research. So Hilary, could you provide some insights to the latest consumer prices in the States?
The consumer price index increased 0.7% month-on-month in June after rising 0.1% in May. The spike in prices was mainly due to a 17.3% month-on-month spike in gasoline. Core prices, on the other hand, rose 0.2% in June, following a 0.1% increase in May.
Do the numbers suggest the inflationary pressure are intensifying in the near term?
Okay, in tandem with the rally in equities that we saw back in March, commodities have since moved sharply higher. The Commodities Research Bureau Index recovered approximately 32% and has recently declined again by about 9%. This has led to concerns that in the near future we will see inflation intensifying. To add on to the inflationary concerns, the popular belief is that the government's continued efforts to stimulate the economy by printing new money will devalue the dollar and cause inflation. Okay, however, we don't think that inflationary pressures are intensifying, even though the month-on-month numbers have risen. Overall prices are down 1.4% in June from this time last year. This is the biggest year-on-year decline in almost 6 decades. The latest drop in the price of crude oil also means that we should see some of the spike in gasoline prices reversing back over the next couple of months.
What about deflation?
Okay, deflation generally means a decline in the general price level of goods and services, and at present we would think that deflation will probably poses a greater threat. Okay, while we do not deny that there has been improvement in productivity, which indirectly implies that demand is actually forthcoming. Okay, but these numbers actually recovered from very depressed levels despite the improvement. Okay, and the indicators are actually remain very much below the norms. In addition to that, there is actually a high amount of spare capacity in the market. The latest capacity utilization rate actually stands at 68%, which is at historical low. Okay, as such, the improvement in numbers is insufficient to intensify inflation. Okay, moreover, soaring unemployment rate is likely to put downward pressures on wages, and in turn, this will cause demand for goods and services to fall further. Okay, for equilibrium to actually establish, prices will have to fall as well, and hence deflation seems like a more probable scenario.
Lastly, how is a deflationary environment likely to affect equities?
In a deflationary environment, profits are likely to remain subdued for some time. In turn, that will have an impact on stocks. So investors will once again be put back into a reality check and realize that the rally seen to date is actually hard to justify.
Thank you, Hilary, for your time today. With that, we come to the end of this week's Market Watch. Tune in next week for more market updates.